before we go to commercial, I just want to make kind of one subtle point. And as I click here, what you're going to see, what rate of return, minimal rate of return do I have to get on my extra $1,000 a month to be able to have that grow to be enough to pay off the mortgage in 15 years. So let's say I choose I want to control my cash flow, but I would still like to have a paid off home in 15 years. Remember, we talked about a little bit in the last episode, the two safest places for somebody to be is a home fully leveraged or a home totally paid off. It's the in-between where we have like $50,000 left to pay on $1 million home that we really can be in danger of going into the green pile of the special assets division if we ever had to try to negotiate payments with the bank. So what return do we need just to pay it off in the same timeline? Drum roll, please. 3.57%.
And it does say net after tax, although I want to point out that we've left tax brackets at 0 to totally leave taxes off the table of this equation because, frankly, the government's already changed the benefits of interest tax deductions in the last few years. It'd be an easy thing for politicians to continue and just take off the table entirely. So we're doing that here.
But we did run it with a 30% tax bracket prior, and all you had to earn was like 2.8% to just pay off your mortgage in 15 years. Now, most of you listening probably don't consider yourself Warren Buffett when it comes to investing. But nearly everybody we have a conversation with is like, well, I could outperform 3.5% over time. And that's the hurdle rate it would be to still have the home paid off in 15 years. But let's look at it.
Paul,
go ahead.
Something just occurred to me. Our conversation around the bank wanting us to pay it off faster so that they can hopefully lend it out higher at a higher rate later. Picture in 15 years, if interest rates have crept up that whole time and now mortgages are in the 6 and 7% range and your savings account pays you 4, let's just say. Well, then you might want to be able to make the choice to just let that mortgage ride, as they say, keep that money growing at a faster rate and continue to pay down that mortgage as soon as possible. Now you're doing exactly what the bank wants to do for themselves, but for you. You have all the control.
In the late 90s, when I got into this industry originally, so yeah, I've been around a while. It's been 23 years. I'm
gray is on the underneath of the beard.
That's right.
But it's there. Yeah.
I'm still working through my issues around having done something for 2 decades running. But the thing to consider is my money market account, when I first got in this industry, was paying 4.5%, 5%. And that is not that long ago. When those times happen again, now you'd want control over your money and your mortgage and choose whether or not to pay it off. Now, one other just small note, and then I'll have Cory take us to commercial, but this is just kind of sharing from my heart in something that we've watched nearly universally. And that is that if somebody's buying a big ticket item, whether that be a home, an RV, a large boat, etc., the way people go about financing that purchase and the way that they think about the purchase versus if they have a check that they can write to make that big ticket item purchase. They are entirely different decision sets. People negotiate differently. People do all those things because that loan that you're taking is a lien against your future capacity to earn an income. The collateral, whether it's the car, the boat, the RV, or the home, is the thing that they take away from you as a societal consequence for you not paying your mortgage. There's nobody who buys an RV with a 20-year loan on it and they drive it off the lot, it drops 30% in value, that if the bank came and took that tomorrow, they would get nowhere near their loan paid off.
Right.
They are leaning against your future income or your other assets. In this case, I just want for all of us to think about that. You're probably going to feel, it feels a little bit different. It's just $1,000 a month different to a 15-year mortgage. It will feel very different than that if you're looking down the barrel of, okay, now I'm going to write a check to pay off this mortgage for over $200,000 in 15 years. And you might find you'd rather control your money and just keep letting the bank take its payments. Because there's another thing that's helped you. Cory, just share a touch before we go to commercial about what inflation does in a positive way to that mortgage payment.
So if you've got a 30-year mortgage payment, what was the payments on there?
1,700, just under that. I'll go back to it.
1,700. Mm-hmm. Yeah. So, as inflation creeps up over time, that mortgage stays level. So that $1,700 costs you less and less every year because you're still getting paid an income that is inflating over time. Or if you have at least cost of living increases in your income. So that means, 15 years from now, that mortgage could actually cost you half as much, even though it still says $1,686.42 on the payment.
Yep.
Every year. That's a beautiful thing. It's one of the cases where we can make inflation work for us in a very beautiful way.
Hey guys, so glad you could tune in and watch that video. I want to remind you to subscribe. Be sure to hit the notification bell so you can get the latest piece of financial knowledge we release. And don't forget, go to Amazon, get a copy of Sound Financial Advice. Why? Because it'll make you better looking and smarter.